Good morning, and welcome to our discussion on robo-advice. Automated investment advisor sites are obviously getting a lot of buzz in the trade press, and the objective of this session really is to discuss broadly how they are going to have an impact on our industry and specifically what that means for financial advisors and financial advisor practices. Before I introduce our panelists, I'd like to take a minute and set the stage and just make some industry observations about the robos. So as we've defined robo-advisors, we actually have tallied about 37 or so in the marketplace, which you can see on this slide here. And actually, I think since I put this slide together, a couple more have come into the spectrum. One of the things that's important to note, even more so than the number, is really how we've categorized them. I think the middle column there, the B2C players, the folks that are going direct to investor, are the ones that capture a lot of the buzz with the press. But I think it's also important to note that there are really two other categories of automated advice sites. One that's been around actually a lot longer than many of the direct-to-investor sites, and that's the managed account providers that offer an automated solution to plan participants through sponsor-provider relationships. And then on the right-hand side, and this is kind of becoming a very busy area within the robo space, the enablers for advisors, becoming more and more crowded by, it seems, the week. For the last two buckets, we see that there's both branded solutions and white-labeled solutions. Obviously, the direct-to-consumer robos are all branded solutions. When you look at the investments, everyone talks about the billions of dollars that are going into the robo sites. But just to set the perspective, we're still only seeing that it's really just a very small fraction of retail assets. Actually, on the defined contribution side, again, partially because of the fact that a lot of these providers have been around longer, we see they've been able to capture about 2.5% of overall assets, whereas on the non-defined contribution side, it's really just a fraction of 1%. So all in together, we're still talking billions, not trillions. One of the reasons for this is that many of the robo-advisors really have kind of a mass market focus. They're looking to go after Gen X, Gen Y, or the millennials, and so naturally the account balances are going to be lower than their baby boomer or greatest generation peers. However, we are seeing providers that are starting to go after boomers, both pre-retirement and in those that are in the decumulation phase. We're also seeing a lot of success from firms who are augmenting the robo experience with an advisor, and the result of that is that they're able to capture an average account balance, in many cases, 10 times the industry average. Finally, on the fee side, we see kind of a wide variety of fees across different types of solutions that are sold through advisors, solutions that have kind of dedicated advisors, solutions with advisor call centers, and then kind of solutions that don't include the advisor at all. The average basis point range that we see is usually between 25 and 30, I guess however you slice it and whatever model you look at, one thing is certain, and that's that a lot of these robo-advisors are offering advice at a fraction of the traditional fee, which according to Price Metrics last year was right around 100 basis points. So with that, I'm going to introduce our panelists. I'm going to start with David. David is the CEO of Oranj, a software application that allows advisors to become more digitally enabled. Oranj provides tools and capabilities that address the needs of today's client, enhancing the client and prospect experience and collaboration. Launched in 2013, Oranj currently serves over 600 advisors. Oranj was created out of the needs of David's RIA firm, Main Street Financial, a multifamily office serving the greater Chicago area and families around the country. Main Street was formed in 2011 and manages almost $300 million in assets. David, welcome. Kyle Ryan serves as Executive Vice President responsible for Personal Capital's advisory services. An early member of Personal Capital, Kyle joined in 2010 prior to its launch. Since then, he has overseen the growth of Personal Capital from 0 assets under management to currently over $1 billion. Kyle is responsible for all the firm's advisory personnel and is a member of the investment committee. Last year, he was named to Investment News' 40 Under 40. Kyle, welcome to the panel.
Thank you.
And last but not least, Tricia Rothschild. Tricia is the head of Global Advisor Solutions for Morningstar. She sets the strategic priorities for the firm's wealth management and online brokerage offerings by leveraging client, industry, and market input. She previously managed Morningstar's advisor software business and led the development of the firm's equity research business from 2003 to 2012. In her more than 20 years at Morningstar, she has led aspects of the firm's business, serving each of our 3 core audiences: individuals, advisors, and institutions. She's a CFA, and she's on the board of Y-Charts, a Chicago-based firm that specializes in stock research, tools, and analysis. Trish, welcome.
Thank you.
So Kyle, let's start with you. As you saw on the slides, in fact, I'll go back to this one here, it's a very crowded marketplace. Can you tell us a little bit more about Personal Capital, your role at Personal Capital, and really how you can stand out in the crowd?
Sure. So at Personal Capital, we really believe we're kind of the new breed of financial advisor, and we combine 2 things. So we provide free financial tools, and we have about 800,000 users, and this is through the web, iPad, iPhone, even Apple Watch. And we have 800,000 users tracking about $150 billion in assets. And we even this week launched our new retirement planner tool, which is a great way to give people insight. That's all part of our free software. And then we combine that with dedicated financial advisors. And we're now managing $1.5 billion, and that's from 0 3.5 years ago. And dedicated financial advisors providing full wealth management and financial planning. So we are utilizing the data that comes from our financial tools in conjunction with dedicated financial advisors to provide, in our opinion, a great overall experience from technology to customized financial advice.
So Kyle, you've actually kind of coupled a digital solution with advisors. Trish, let me ask you, do you feel like with the popularity of a lot of these more automated solutions, the advisor is still relevant in the industry?
Oh yeah. I mean, this is a disruptive force for sure, but it's, in my opinion, it's a pendulum that's kind of swinging, and it will settle. And the role of the advisor in the human relationship, and especially in complex cases, is not going to go away. I mean, you can wear your Fitbit and track your steps and do all sorts of things digitally, but you still might need like a coach, right? Like otherwise you're going to binge on the cookies at night. Like somebody who's there with you every step of the way to help you solve some of those more complex problems, I think is really critical.
So Trish, are you saying that over a longer period of time, some of the solutions that don't augment the experience with an advisor are going to struggle to compete?
I think that overall the whole trend is great for the industry. There are a lot of underserved investors. There's a lot of small asset households where having an investment solution at all, the digital experience, the simplicity is great. And then I think as you go up the spectrum of complexity, having an advisor and somebody who's really kind of overlaying, mass personalization will work for a lot of people, but then I think there's an overlay that's going to continue to be required.
David, so you're a financial advisor, and that's kind of where you started, but you weren't able to serve your clients in the way you wanted to serve them, delivering a unique value proposition with the software that was available in the marketplace. So you basically took matters into your own hands and created a solution so that you could better serve your customers. Can you talk a little bit more about your firm, Main Street Financial, Oranj, how it came to be, and how you help now over 600 advisors offer a digital solution to their customers?
Sure. So Main Street Financial multifamily office, we're serving about 27 families, and we're working with ultra high net worth individuals. And what we saw in our business was that they just really wanted a higher level of service. That's why they were coming to us instead of working with some larger big box firms. And that's what we provided to them. And we just really listened to our clients over a number of years, and we thought that we were really doing a tremendous job for them with all the analysis we were putting together, meeting with their estate planning attorneys, really kind of being their financial quarterback. But our clients' lives change dynamically, right? What's important to them changes from day to day, month to month. And our service model was quarterly performance reviews, annual reviews, calls on their birthday, maybe take them for a round of golf in the summer. And our clients, I think appreciated that, but really what they told us was, I don't want to look at another spreadsheet. I don't want to look at another 10-page cash flow analysis. They wanted us to reach out to them when there was something meaningful, important to talk to them about. And that's what led us to go out to the marketplace and really look for a solution. We didn't find that solution, so we decided to build it ourselves. And we didn't really build Oranj with the intention of becoming a software company. We built Oranj really out of the needs of our own business. So that was kind of really the catalyst behind Oranj. And as we got into that development process, it made us take a really hard look at our business, right? Where are we spending our time? Where can we spend our time most efficiently, right? And really the two areas are doing a really, really good job of client management as well as business development. And there were huge, huge inefficiencies in our business development process. And whether you're working with ultra high net worth individuals or mass affluent, the same ratios in your business apply, right? You have to meet with a lot of prospects, all right, to generate just a few clients. So we wanted really a better way to connect with prospects, demonstrate value, because we were getting referrals. We were seeing that we were having a small percentage of those referrals turn into first meetings. And that's really where we wanted to focus our attention on the business development side. And then on the client management side, we also looked at our business, and these were clients that entrusted a significant amount of assets to us. And there was about 50% of our clients, it was hard for them to come in for an annual review. And we just reflected and we're, what's wrong with our clients, right? Why aren't they coming in? This is what they're paying us for. But it was the experience, right, of asking them to gather up their financial documents, come in, have a meeting, set some goals, lay out a plan. They didn't really want to devote the time to that, right? So we wanted a solution to really help meet them the way they wanted to be met with.
Right. Kyle, easy-to-use technology and innovation has kind of helped you see the growth that you've experienced over a short few years. Given technology's role in your growth, why don't you feel like more advisors are embracing a digital approach when working with their clients?
Well, obviously it is our growth story, right? And that was the premise of starting Personal Capital, that we can provide a better client experience by starting with great technology and people together. So our DNA is both. So the main reason is it's hard. I don't think any advisor would say, hey, we don't want to give our client great digital tools and access. Some might, but it's just really hard. Most advisors and businesses have existing businesses that are successful, and how do you integrate it? It's just a really hard thing. For people to add accounts and make that easy experience, we raise a bunch of venture capital and have a bunch of great engineers and team that have made that easy client experience. So I believe it's important for everybody to realize that every touch point that your client has to you is a reflection of you, right? And our belief is that it's woven and tied together. And the only thing I think holding back advisors, it's just hard. How do you actually integrate it? Do you build it? Do you buy it? Obviously firms like David popping up. It's just the legacy systems. How do you integrate it into it? Obviously you have the graph up there. There's so many companies popping up trying to help advisors do it. But it's still difficult, because if you just bolt on this one thing, but it's not integrated into your client experience, is that really the best thing? So I think it's just challenging. Every big bank in the world talks to us, is interested, but it's just difficult for them to actually do.
Trish, on one of the slides that I showed, the one with respect to all of the industry players, Morningstar's logo was on that one, but Morningstar's not traditionally thought of as a robo-advisor. Can you answer the question for us? Is Morningstar a robo-advisor? And then how is Morningstar helping to add scalability and efficiency to advisors' practices?
Sure. I guess that's why we think of it as an evolution, not a revolution, because we have been providing automated investment advice to retirement plan participants for many years. There's over 1 million plan participants in the United States who access Morningstar's managed account service through their workplace. And I think in a workplace context, there's studies that show kind of the value to the end investor from sticking with a managed account solution and the discipline that comes with that. And I do believe that that investment discipline is something that really benefits investors, whether they're in a 401k or outside of the account. And so for non-401k participants, we also offer managed portfolios, which is where the advisor is outsourcing that portfolio construction to Morningstar. And that's another option. I really think of it as like a spectrum of service. And the individual investor has an increasing amount of choice, which is great for the end investor in terms of how they want to be served, whether they want to be completely do it themselves, whether they want to work with an advisor partially, but still have more engagement themselves, which some of these client portals really facilitate, or whether they really just want to outsource it all the way to an advisor. So that's good for the individual. And then the advisor has the same spectrum of choices. So the advisor can do all the portfolio construction themselves and add value through that process, or the advisor can add value through, or in addition, through financial planning. And that's where the managed portfolio service comes in that we offer. So if you don't want to pick the stocks yourself, but you want to use the Morningstar, 100 analysts to do that stock selection for you and come up with kind of a customized SMA, you can outsource that. And there's a couple of reasons why that's probably a fast-growing part of a lot of advisors' practices. And then there's advisors who might choose to outsource even more fully to a fully automated solution, across the brokerage accounts as well as the retirement accounts.
David, so I'm going to ask you, you're an advisor. Trish talked a little bit about how advisors are increasingly looking to add efficiency by outsourcing that investment management piece and potentially adding value in other areas like behavioral coaching or financial planning. What's your stance on outsourced investment management as an advisor? Does it bring that sort of scalability that can benefit your practice?
I think it can in many cases. As wealth managers or financial advisors, we're all obviously really passionate about the investment industry as a whole. As a business owner, you have to look at where should I spend my time that's going to most positively affect developing business and serving my existing clients. So I think in many cases, outsourced investment management can free up the advisor to do the things that are going to actually drive their business. And I don't want to throw out a bunch of kind of industry statistics here, but any industry study that you may read, Cerulli, Moss Adams, there's many of them. They really show that the advisor spends more time on administrative tasks than they do on business development, which is a problem for any business. So I think when you're looking at your business, anything that you can do a better job of that's going to drive growth in your business, as well as sustainability, and offloading that is definitely beneficial.
Without decreasing quality of service, right? The investment proposition is incredibly important in that equation. And I do think this disruption of the robos is what it really does is causes advisors to look at their practices as businesses and understand how to, deliver the value at the right level of cost or time.
Right.
And one of the ways an advisor that I have talked to a lot recently was describing it to me. He's like, think of you have a pie, right? It's 100% of your time. If you can take that 100%, and maybe in the past, like you did all the work all the time with your client yourself, take that same 100%, and a third of it the investor could do themselves with the right kind of engagement model, client portal, assuming they have an interest, right? They can, and actually if the investor's more engaged, they're probably going to tell you more anyway. When an investor puts in their goals, they might put in more like 8 goals. When an advisor puts in goals, they put in like 2.5, right? So the investor's going to tell you more if they're engaged. So that's maybe 1/3 of the pie is the person doing things themselves. Then there's another third that technology can facilitate. So maybe there's a more streamlined way to get that person with that profile into some kind of asset allocation or generally appropriate portfolio. And then there's 1/3 of the time that the advisor is coming in to do the real hands-on work, making sure that it's right for that particular situation. So if you think about that allocation, the way that advisor described it to me, That guy just cut out 2/3 of his time because he's outsourcing to the investor and to the technology. And maybe there's some fee compression that comes with that, but there's fee compression everywhere anyway. So maybe they have to lower their fees by 20% in order to accommodate that kind of hybrid model. I think that's probably a pretty good trade-off. They can do more business, serve more people, influence more investment outcomes in a positive way at a lower cost.
Yeah,
Please.
well, you raised a couple really good points there. I mean, one is the interpretation of the advisor of, what areas do I focus in on, right? And with a lot of the digital tools that are coming out there, how does an advisor kind of digest that and understand what do they need to do to really kind of apply their business, serve their clients in the way that they want to be served? And outsourced investment management, I think, is certainly one component of that. And really, I think understanding what role do you play? Are you an investment manager? Are you a relationship manager? You're also a business owner. Balancing those things, as you said, related to that pie is the challenge. And that's the business decision I think advisors have to make.
Kyle, so let's talk a little bit more about your model. So 100% of your advisor-client interaction is done virtually. There's never an in-person meeting. Tell us a little bit more about the model, how you see it playing out. And do you think more and more traditional advisors are going to adapt in a similar way?
Sure. So it's more about 99%. I mean, we have offices in San Francisco and Denver, and if clients are in town, they definitely do come by. And to jump on what you guys were just talking about, we actually role specialize, and that's one of the advantages when you start from the beginning as a business as opposed to an advisor trying to figure it out. And the virtual meetings allow for two things. One, I think it's actually a better experience for a lot of clients and prospective clients. It's just convenient, right? I mean, a lot of people don't want to have to spend the time to drive and go to an office. I mean, some people still do, but a lot of people, it's convenient. I mean, they can do it on their iPad at a conference room at work, right? It's that easy. And as an advisor, you're so much more productive. No travel time, a lot less preparation time, and even just virtual meetings tend to be a little bit quicker. In-person meetings tends to be a little bit more chit-chat and shooting the breeze, if you will. So through our role specializing in virtual meetings, I mean, our average advisor brings on 12 new clients a month, and our average relationship's over 300,000. So that allows us to just be super efficient, and also we do believe provide a better client experience because every virtual meeting is a collaborative one where we're sharing either what's going on in their financial dashboard and their goals, or it's a proposal that's collaborative that we're doing. So collectively, I think it's ultimately a better experience in a lot of cases. I mean, obviously some clients, and of course there's some value in meeting face-to-face when appropriate. I mean, not discounting that. But if you look at just the pure efficiency as a business, it's great. And ultimately, you can collaborate really well utilizing technology. So I think absolutely it's gonna be more and more popular. I mean, McKinsey did a study that came out last month really talking about the virtual advice model globally being a huge wave that is happening. And that's basically what we've built on. And it is the role specialization piece is huge. I mean, we have advisors that just focus on business development. We have advisors that just focus on relationship management. We have operations specialists. We even break out our sales process. So all those things allow us to just be super efficient in how we ultimately deliver advice.
So this is an investment conference after all, so let's change gears for a bit and talk a little bit about the investment approach that you take, Kyle, specifically. Mm-hmm. You actually sit on Personal Capital's investment committee. Mm-hmm. Tell us a little bit more about how you guys approach things.
Sure. I mean, the easiest way I would describe it is, we kind of call it smart indexing, if you will. And it does start, one great thing that we have is we have people's actual data and financial information, so it does allow us kind of do things a little faster than if you don't have that information. So we look at that, and basically it's all about trying to give people the best chance to meet their goals and doing that in a pretty straightforward way. And we believe in global diversification, basically based around modern portfolio theory. But from there, we do some things a little bit differently. We more equal weight of various factors in the U.S. equity market and use individual stock sampling to do that. We do place a huge emphasis on tax optimization, so we manage across households, and so it is important what type of security you put in an IRA as opposed to an after-tax account, and just a huge focus on doing that and rebalancing. But ultimately, we don't place the emphasis on trying to pick stocks and pick the next hot sector. That is just, our view, most people don't need that.
So Trish, you had talked a little bit earlier about how Morningstar has a automated solution for plan participants, but as it relates to kind of ways that we add efficiency and scalability to an advisor's practice, one option is to help them with that investment management piece through our managed portfolios. Sticking on the topic of investments, can you talk a little bit about the investment approach that Morningstar takes when managing portfolios on behalf of advisors' clients?
Sure. So, I mean, we have our roots. I was an analyst when I started in the early 90s, and clearly we believe there's a role for active management in the industry. I thought yesterday's panel, active-passive discussion, was fabulous. And there's cases where, as the Dodge and Cox woman was saying, like time horizon arbitrage, there's inefficiencies in the market, there's lots of ways for a low turnover, long-term fundamental investment strategy can add a lot of value. And we have built a couple of our stock basket portfolios around that methodology, and then even within the fund selection, there's a role for active management. But it is true that there's fee pressure, and for some investors, and this is kind of maybe in the 401k plan participant space where there tends to be lower balances, I mean, it is better to invest than not to invest in most cases. So if you can use the simplicity of the digital experience and it's a well-constructed, passively managed ETF portfolio, that is a less bad option than sitting out and not participating in the markets by and large. So I think that there's a role for both, and it depends on your goals and the level of engagement, and then the investment professional that's working on your behalf and how they can add value in that process. And I also totally agree that that household view is really critical, because ultimately it's not about what happened this quarter or next quarter. It's about, are you going to meet your goals, and what are your priorities, and do you understand what trade-offs you're making? And that's where, in my opinion, an advisor coming into that kind of coaching place with the person who probably isn't that well-versed and maybe is willing to be engaged, but they have a day job. And so the advisor who's there to help with those trade-offs and do that kind of coaching, tell them what not to do in addition to what to do, understand when an active strategy would be more appropriate than some kind of fully automated strategy. I think that's the balance that you'd look for.
Let's turn the conversation a bit to fees, and I'm going to get my slide back up here. David, if we've learned anything from the robos or the automated sites, it's that they can offer risk-based asset allocation at a fraction of the price of a traditional advisor. What sort of, I guess in general, do you think low-cost access to investment advice is a good thing? And then what pressure do you think that puts on the traditional advisor model?
I think that it's a good thing for the right investor. Different people are looking for different things out of an advisor or a professional that they want to work with. I don't really think that it's anything new. Low-cost investment portfolios have existed for a very long time. I think that there's just a lot of new players into the space that are bringing attention to it in a much larger way. And that's really, I think, also goes inside with a really big shift in consumer behavior, where they want to work virtually. They're working virtually with people and on demand in almost every other area of their life. The second part of that question, I don't believe that it's really forcing the traditional advisor, to compress their fees, because really it's a different service. If somebody wants to go and just have an investment account managed and leave it at that, there's plenty of solutions for them out there to do that. And we're seeing a lot of the larger firms, provide those digital solutions along with Personal Capital and Wealthfront and a number of others. But when someone wants, more than that, and wants to have help outside of their portfolio, that's where they come to everybody in this room. And you get what you pay for, right? So if you want to go to a discount retailer, you can go to a discount retailer. If you want to go to the difference between going to, like a Walmart versus a Bloomingdale's, right? I mean, there's different experiences and different services for different people.
So if I would jump in though, I mean, the challenge is though, advisors actually have to prove that they're Bloomingdale's, right? I mean, that's the challenge, because what a lot of people offer, right, is the value really there? And it might be, but even when you're interacting with prospective clients and your clients, just what are you doing to justify the extra, in some cases, more than 1% a year? So it's a challenge. I mean, I don't think there's this huge, massive fee compression. I mean, we're way more than the robo-advisors, and we believe we have to show people why and add value. And even our software, I mean, we're fully transparent, and we show what people are actually paying when they're with traditional advisors, in both advisory fee and fund fees. And I think it is happening more and more where everybody's going to have to show value, not just, hey, I'm great, you like talking to me, that's worth an extra $15,000 a year, right? In some cases it might be, but I do think there's more and more pressure to show how you add value and actually try to quantify that to people.
Which is also, I was going to say, it's also a good thing because I think it facilitates a change in the conversation, which ultimately will lead to, I think, better investment outcomes and probably more confidence in the case of the investor, in the sense that if the advisor is talking not just about the investment portfolio, but about the other factors that it is how advisors add value by looking at, when is the right time to take your Social Security? What's the value of your real estate asset? What about your personal capital? I mean, there are a lot of other ways, other assets that people have that they don't always think about when you hear like where the Dow closed. You don't think about the other sources of your total wealth. And so in an advisory relationship, the advisor can really play a role in helping the person understand that, yeah, maybe the market fell, but that's okay. You have other sources of wealth. You will be fine. Don't bail out. Don't panic. Don't sell. Let's focus on your longer term goals. And so the fact that the advisor is, because of these other trends in the industry, is maybe that conversation is being accelerated or, brought to the fore, I think that's a really positive outcome.
So over the last 12 to 18 months, we've seen some pretty interesting activity in this space, some acquisitions in the form of LearnVest and Upside. We've seen some pretty disruptive new entrants come into the market as well. When the dust settles, and maybe more importantly, after the bear market or the bull market rather comes to a conclusion, how is this all going to shake out? Do we feel like there's room for everyone? Or are the custodians and product providers going to have a competitive advantage, or the firms that have an augmented solution with advisors? Are they going to be around? I mean, is who's going to come out on top, and is there room for everyone? Kyle, maybe we'll start with you.
Well, obviously, personal capital is going to come out on top, right? No, I mean, hey, that's a great question. I mean, obviously, there's a lot of movement going in the industry right now, and my take is, hey, that some of the pure robo-advisors, I mean, maybe some of them are going to be sustainable. They're doing a great job disrupting. There is a question on the sustainability of an actual long-term business model when you don't charge very much, right? And so they're probably going to have to evolve over time. And so they are doing a good job marketing and creating experience and building brand. And so some of them might be successful doing that. Obviously, you're going to have some existing players do a great job adjusting, right? Whether that's Schwab and Vanguard or the ones out in front or others. And then a bunch aren't going to make it. I mean, there's a lot of them up there, and won't name names that, geez, I mean, if you actually go to their website and what they're doing, it's pretty shocking that people are going to invest with them. But it's a pretty exciting time in the industry. I mean, and being in the forefront is a great thing for us at Personal Capital. And I mean, we believe just our model is the way the industry's going. I mean, whether we're the clear-cut winner or not, but it's not this whole either-or thing. And even products like David, it's digital. How do you interact with technology and advisors? I mean, that most people want some combination of that. right? I mean, maybe not all the time wanting digital, not all the time wanting advisors. So it's just going to be the firms that do that well, I think, will ultimately come out on top, and it's probably going to be a lot of firms, because I think the whole industry is going that direction.
Trish, do you have a perspective on how this is going to end up?
Well, Morningstar's equity research team did an independent study from an investor's point of view. I mean, if you were evaluating these companies, especially obviously those that are publicly traded, so we had more insight into those, what is the sustainable model? And the model that our analyst put together to do the valuation, which we're happy to share with any of you that are interested. His name is Michael Wang, and if you give me or Nick your cards, I'm happy to get you a copy of that research paper. His conclusion was that really the cost of client acquisition is so tremendously high for most of these players, except for the custodians who have already a cost structure that supports the cost of the client acquisition, and those custodians are the ones whose model will be most sustainable. And having an advisor hybrid model was another kind of conclusion that was more likely to lead to better outcomes.
Yeah, I think it's a challenge. Just in we're not in the robo game, but looking at the amount of capital that's been raised, and studies like Morningstar, and I think A.T. Kearney had done one in terms of what are the shifts of assets that are going to be going to these platforms over the next 5 years, and it's like about I've seen anywhere from like a trillion to 2 trillion in terms of assets, and given the players that are out there in the space, I think it's going to be really hard to have a lot of different options. But I also think, to Kyle's point, that there's different experiences and there's different services for different people. But from a fundamental standpoint, given the amount of capital that's been raised for a lot of the robo startups, I think it's going to be really hard, especially with some of the larger wirehouses and custodians, starting to gather those assets too. So 2 trillion is not enough to sustain the robos that are in the space today.
So guys, before we open it up to questions from the audience, my sense is within the room here, there's probably quite a range of experiences that advisors are offering to their customers. Some have embraced digital and automated solutions. Others are still kind of on the far traditional side of the spectrum. Do you guys have any advice for the group as folks that may be looking to bring more digital service models into their practice? Kyle, we'll start with you.
I mean, one is I think you have to do it. It's not just a millennial thing. I mean, I think that happens in the stories. I mean, we have millennial clients, but most of them aren't. And your clients want digital tools. They're going to go download the Personal Capital app and play around with it, or search out other tools. So your client experience is also how they interact, technology, all those things, because a quarterly meeting is once a quarter. What's their experience those other 90 days? So you're going to have to do something to create a better overall client experience. And how do you interact with technology?
David, what do you think?
We meet with a lot of advisors on a weekly basis that really have this same challenge, right? This digital dilemma, and every advisor has a different view on their business, and I think the direction that we tried to educate advisors on is what does your business look like today, right? And how can you adapt technology so you don't have to change your business? Right? And I think a lot of solutions out there can tend to force advisors to kind of change their business model or insert a second level of service. And for most advisors, small, mid-sized firms, that can create greater inefficiencies, right, in how they run their business rather than actually create efficiencies and scale. So,
Tricia, any final thoughts?
Yeah, I think it's a time for some introspection for many advisors. The advisors on our advisory board, which convened yesterday, talked a lot about the thoughts that they're having in terms of segmenting their client base, understanding maybe how they would serve the next generation of clients. How do you reconcile the service model that you have in place very successfully for some of your more established affluent clients with perhaps, somewhat of a lighter touch model for some younger or newer clients or less affluent clients, and can you articulate the value proposition along that spectrum clearly in your practice? So it's not easy, but I think it is part of that evolution, and ultimately, if it helps advisors deliver better investment advice and helps more people reach their goals, I mean, that's kind of why we're all in this business. So, I think it's kind of a good challenge.
Great. At this time, I'd like to open it up for questions from the audience. I believe we have a microphone, so if you have a question, raise your hand and we'll get the mic to you. First one's right here.
Thanks. Kyle, your firm does a really good job of getting a lot of press, and I assume that helps you attract those 800,000 clients. But Morningstar has this concept of a wide moat firm, and I'm wondering what your wide moat is. I can go out today and buy similar technology from David's firm and as an advisor and create the same kind of experience for clients. Do you think what you're doing is sustainable and unique?
Yeah, I mean, I would say you can't do that. I mean, if you actually go use our app, you'll find that out. I mean, what we've done and built, nothing is close to it. To be able to see your entire financial picture, the insights we give. I mean, our new release of Retirement Planner this week, and there's already a bunch of press around it, and it's positive press because it's good. And I mean, we have spent so much time in technology and engineers to create a great experience. So the wide moat is we have by far the best technology and user experience, and everybody else is going to be catching up to us. There are a lot of firms trying to do it. E-money, all those things. You go to E-money's pitch is, check out Personal Capital. You guys need to do this. I mean, that's their genuine pitch.
Okay.
I think we had another question right here.
Yeah, a couple of you talked about not doing the traditional in-person meeting. I wonder if you could talk about how you reach out to clients on a periodic basis and maybe nudge them, and is that structured around life events, or is it structured around, things going on in the market? And if it's the latter, do you rely on investment managers at all for insights there?
I'll take a quick stab. I think the nudging part, I mean, there's a huge runway for better behavioral cues and data based on life events, and linking kind of the financial plan up to the rest of the ecosystem that an advisor uses can give you some really good insights into when a bad behavior might happen, like before it happens, right? So Morningstar acquired a company last summer called Hello Wallet, which does this type of work within a retirement plan context. And so to the extent that that type of data can be available to advisors to help them ultimately be a better coach for their investors. That's not necessarily, I mean, it could be driven by life events. It could be driven also by market events. I mean, you can combine that with, investment research to show if there's a manager change or there's a huge correction in a particular position or sector, or there's some mispricing in the marketplace that could actually be an opportunity for more investing. I think all of those cues and signals, I mean, that's why the technology, if it's done well and the data is flowing correctly, can add so much value to ultimately deliver a better outcome.
Yeah, I mean, we use basically all of the above. I mean, so we periodically reach out to clients, and some clients, you do it quarterly. And I mean, we have the robust data on everyone, and so we do utilize that as cues, whether it's how they utilize our app or some changes in their investment accounts. I mean, we utilize that all as cues to both reach out to clients and prospective clients.
And we use a similar method as well, where really through the advisor's dashboard, you can see interactions as they occur in real time. So as a client adds a new goal, or maybe they change their retirement age, right? Those are client management opportunities to say, Mr. Client, Mrs. Client, why do you change your retirement age from 67 to 70, right? Or I actually see that you are now falling behind tracking to your retirement goal. Those are all client service opportunities. On the investment management front, whether you're outsourcing that investment management or you're managing it yourself, we're not really kind of a robust kind of an investment analysis tool like a Morningstar Direct or Morningstar Office, but we do provide the advisor insights into what clients should they be reaching out to, what prospects should they be reaching out to, and really providing something meaningful to talk to them about.
I think we have another question over here.
Yeah, my question is for David. How would you recommend an advisory firm actually evaluate these software providers?
That's a great question. You know, there's so much out there. I mean, there's a lot of players in the robo space, but there's also a lot of solutions that are coming into the advisor space. And you know, I think we touched on this a little bit earlier, but you really have to take a look at your business and know this is what my core service is. This is what I'm going to hang my hat on, right? And this is the experience that I want to provide. So no technology provider is going to know your business better than you guys do. And you know, it's interpreting the type of experience that you want to provide to someone and understanding how to adapt and apply that, I think is critical. Don't try to change the business that you're running today.
In the back? No? Any other questions? One right here.
It seems like most of the digital tools I've examined utilize passive ETFs as part of their quest for lower cost products. What impact, it seems mostly negative on active managers. Is there any positive for active managers from the use of the digital tools?
Well, it's an opportunity to differentiate, right? I mean, just as, I mean, that would be mine. I mean, there's actually now some active robos. Yeah. I mean, it was inevitable, right? Because everybody's been more passive. So just as a business, obviously it's an opportunity to differentiate and add value if you can do it well.
Thanks. Now, just to follow up to my earlier question, the rest of the panel was kind of quiet. Kyle said they have an unassailable lead in technology. Trish, do you believe that? And you know, Morningstar obviously has experience, as you said, on the DC side for many years. Do they really have better technology that you can't replicate? And what about you, David?
So I think the point about understanding the investment proposition, so the rigor or the history of the investment professionals, and then coupled with the digital experience. I mean, those are the two pieces of the puzzle that I think are most important, and I think it's pretty easy to understand like the quality of the digital experience. I mean, that's what's so sexy about like logging in and seeing how cool it is, and I know that the experience is really solid. And then on the investment strategy side, I think there's a lot of market environments. There's a lot of fluctuations that can occur. There's a couple of cycles that you probably want to go through to understand how that plays out. And kind of to the question about active versus passive, what role would an active manager play in the portfolio over time? And are there ways that maybe an investment experience that has a little flexibility around that could deliver a better outcome? Those are the kinds of things I would look at in terms of understanding, and also kind of to the other question about how do you evaluate these services, I would look at, well, what's the rigor behind the investment proposition? How do you compare the different services in terms of the tax loss harvesting and the other portfolio construction elements, and then the digital experience, which is probably the most fun. But those are the kinds of things I would be evaluating.
Yeah, I mean, I think from a technology standpoint, I think it's really hard to say where you fit within the breadth of the technology options that are out there, unless everyone got into a room and flipped the hood on their solutions and took a look at what's under there. But I think overall, at least from our perspective, there's no algorithm to be able to determine someone's retirement plan. There's human behavior. There's conversations to be had, and if someone cracked the code on that, right, and in terms of optimizing that retirement plan without having a conversation or just based on someone's available data, I think that's a really, really, challenging proposition, and that's why people hire advisors, right? I mean, there's relationship, there's human behavior, and we get hired to also help them take emotion out of the game as well. So, that's our approach to technology. There's a lot of really smart developers out there. Some of them work for us, some of them work for Personal Capital, some of them work for other people. But I think it's just, again, to the evaluation standpoint, how do you construct a retirement plan? Are you doing it just based on inputs, or are you actually applying conversations and kind of human behavior, into that equation as well?
We have time for one last question.
So my question, it has to do with the size of the clients, because I just don't understand how, a client's tax return can be analyzed, how you can collaborate with their mortgage broker, their attorney, their accountant, and their insurance professional in this setup, or how you can talk about charitable options and review their closely held stock. What kind of threshold are you seeing in the net worth space to deal with these kind of clients? Because I think it's great for some of my clients' kids, but I don't see how it applies to a sophisticated client.
Sure, well, I can talk to that. I mean, we do formally tier our clients. So now a third of our assets are in what we call our private client group, which is $1 million and up. And we do that. We coordinate with CPA, estate attorney, all those things.
That's not a big client to me.
Yeah, well, it's everybody's got different things they're focused on, right? So obviously, our minimum is $100,000. We don't do that level of proactive reaching out to their entire team at $100,000. I mean, granted, they usually don't have the complicated options. So for us, it's tiering the service level based on what actually makes sense for the clients.
Which I would say kind of goes to the other points about, so for your clientele, whatever your average household balance is, it may be not appropriate, but it could be an input for the smaller balance households or for the kids, or if you think about that pie, there might be ways to gain some efficiencies from a client engagement model, as well as then using some technology as a starting point for that construction. But then you're going to have to do the other estate plan, some of the other pieces of that puzzle that clearly come from the advisor's conversation with the clients and the other aspects that the industry isn't prepared to automate. Maybe won't be, but certainly isn't now. It's not either or, I guess, in my mind.
Yeah, I mean, to me, the big disruption, I mean, we say it's the robo-advisors. I mean, it's the client experience and just how do you integrate technology and, all right, I mean, everybody's got smartphones and apps and just, it's an extension of you. I think that's the important thing, and that's at all asset levels. I mean, we have people that have added $1 billion on our platform, right? I mean, that they want these kind of tools, right? So that's the important thing, and I think that's the biggest positive that Robo-Advisors have done. They've created a great user experience. I mean, is it super differentiated in what they do in terms of advice and all those things? I mean, time will tell, but it's a good user experience. It's easy to interact with. People like interacting with them. And I think that's the key just across all asset levels.
Yeah, and I think particularly, I can identify, I think, a little bit with your business, with our RIA as well. And it's what role do you play with your clients, right? Are you the quarterback? Are you the one, coordinating the meeting with their estate planning attorney, their personal banker, their accountant? Their accountant says, hey, I can save you this much on your taxes, and you say, hey, wait a minute, right? Donating all that money to charity is going to affect these things going over here. I think technology can play a role in your business, again, without knowing a ton about it, in terms of providing you context, right? A collaborative platform to work with a client who may be hard to get a hold of, right? Maybe they're a CEO at a company, they travel a lot, whatever it may be. So that collaboration and allowing them to stay connected. And then when they have a decision to make, I want to go buy another boat, right? And they call you up, how should I fund that, right? You don't want to say, get me your updated personal balance sheet, all those things, so I can have a meaningful conversation. Technology can play a role, I think, even for the higher end in that area as well.
Trish, Kyle, David, thanks for a great discussion, and thanks to all of you for joining us.